All right, guys. So, good morning, good evening, based on wherever you are based. And as most of you are new to this class, I will take you to my introduction little and then we'll go to the syllabus directly, right? So, let me show you my profile a brief, and only thing it tells you that I am aging, right? And this is just for an introduction to you, right? As your first class with me. And let me take you there. Let's open the profile. Let me share the file with you. So we have this one here. So let me introduce myself to you. And this is here. This is who I am and what I do. I've been to Western world for last 16 years, working with companies like Ernst& Young and big giant corporates. And then I came to teaching when I did my chartered accountancy in 2007, right here in India in Mumbai. And I worked with Institute of Chartered Accountant. That's what my first job. And then when I was young, I was thinking like I gather more degrees and it will be more beneficial to me. And I wasn't wrong, right? And then I collected all the degrees, right? CA, CCA, CS, CPA of two countries, three countries, right? And IBM and MBA and CS and law and everything, right? All this thing tells you is that I'm little experienced and I'm aging. And you can see I taught at universities including Harvard and IIMS and IIT in India and St. Clair, University of Toronto, and all of that. Right? So let's quickly close it. This was my quick introduction. And now let's go to your introduction. So your introduction to this subject will be based on number crunching, right? I hope you guys have done FM before coming to this class. And that's how your syllabus is being, right? So in a skill level, if you've done FM or if you've done FR, right, it is exactly like FR. I will say FR is completely reflection of the subject, right? It is almost the same thing which you get, right? Same chapters which you get, right? Let me show you and share with you what do I mean. So let's share this file with you. This will be your syllabus, right? So I don't think we'll be playing many slides here, right? We'll be just going through the chapters here. Questions are basically numericals, right? And logical based, right? So, but we have slides as well, right? I will share you when I need it, right? So you see what we have here is all reflection or repetition of FR, what you did in skill level, right? So you have revenue, right? IFRS 15, you have non-current asset, inventory, IAS-2, foreign currency, lease, IFRS 16, employee benefit, right? All of them are tax related party, right? So nothing new you are doing here, right? But you are doing at a little advanced level, right? That what SBR is, right? So what we are going to look today is basically a difficult subject. Which one should I pick? Uh, let's pick foreign currency one. That's I find many times students find it a difficult one, right? It is not difficult, right? I find it the easiest one, right? But still, it's conceptual, right? So if you are little missing the concept, you may go wrong, right? So let's see what foreign currency is, right? So in short, if you have, let me open the chapter here. If you have transaction, like today we live in a globalized world and liberalized world, right? So you have branches all over the world. You have customer all over the world and you have also all over the world, right? We cannot contend to one country or depend on one country today, right? Like look at Reliance, they have branches in all 200 countries. There's no country where they don't have branch, right? And even a small company, they also have branches everywhere, right? So today we have to consider foreign exchange, right? And why this thing is very important is not because of your product or because of your selling skill or anything else, right? Your product is still good, your selling skill is excellent, your management is excellent, but just because there is a fluctuation in foreign currency, it may question even the survival of the company, right? And this will be like kind of a very unfortunate situation, right, if you do not address it properly, right? So we have certain financial tool like uh, foreign exchange management contract, we have forward contract, we have options, right? Many are there, but here we are just looking at the accounting, right? So how you account for when you do a transaction in a foreign currency, right? So first thing you will look into every transaction which we do, right, we have to divide it into two parts: monetary item and non-monetary item, right? And I will take you directly there. What do you mean by monetary and non-monetary? So we have some transaction which you have to settle in a fixed foreign currency amount in future, right? Like look at accounts receivable. So customer's balance, you are going to receive money from them, say after 2 months or 3 months, right, from the balance sheet. So all this monetary item, which is basically account receivable, account payable, maybe cash and bank balance, right? That's also monetary item. So all of this has to be divided into, has to be converted into balance sheet rate. So if my account receivable is say $10,000, and when I sold the rate was say 80, so it will appear at 800,000. But today, because of the rate has gone to 85, I have to show a profit of 50,000, right? So this is basically not a very uh, complex thing, right? Simply divide the all the transaction into two parts: monetary and non-monetary, right? Monetary, which you are going to receive or pay, right? That is settle, right? Which you are going to settle in future, right? And non-monetary are all others. You can say non-current asset. You can say machine you bought, right? Maybe you bought some car, right? You have some furniture, right? So any non-current asset and all these kind of items will go into foreign currency, non-monetary item, right? And this is what is tested in SBR exam quite regularly, right? I didn't mention I was on the board of examiner, right, when I was in UK. So I was doing checking the answer sheet. I even do now, right? I get recently of September 2025, right? And I'm still working on it, right? So what as an examiner, I want to look into you as a candidate. I want a clear cut understanding of these things, right? That you clearly understand what is a monetary item and what is a non-monetary item, right? And then accordingly, you can address the things, right? If you do not know the difference, then everything will go wrong, right? So first thing first, you divide the transaction into two parts, right? Now, whichever is monetary, you convert them on the balance sheet rate. We can also call it closing rate, or we can also call it rate on the reporting date, right? Which is mostly 31st December. So whatever you rate on 31st December, restate all the transaction on that rate, right? And then you calculate the profit and loss on the balance when you receive or make payments, right? For non-monetary item, we don't do anything, right? Leave them on the transaction date, right? Like say you are buying machinery, you're not going to sell machinery every day, right? So in exception situation, you can sell them also, but it's not your inventory or it's not your item which you are going to deal with regularly, right? Or trade in regularly. So foreign currency is something, right? So look at here what we have. We have, if you look at, say here, exchange difference, right? Then we have consolidation of branch and subsidiaries and everything, right? So once we look into, say, uh, the difference between monetary and non-monetary, then all other things become very easy, right? So say we have goodwill, right? Now goodwill is a non-monetary item. I'm not going to sell my goodwill or settle my goodwill, right? Is not even allowed, right? So what we do, we simply put it on the transaction date. Inherent goodwill, right, which is internally generated, you anyway cannot recognize in financial statement, right? Remember IAS-31, right? Intangibles. So we cannot uh, account for inherent goodwill, right? Which is internally generated. We can only account for a purchase goodwill, right? So if you purchase a company and you have a goodwill, right? You will keep on that rate. Like say you acquire a company today, which is 11th of November. So whatever is the rate today, you converted, you calculated goodwill, it will just stay on your balance sheet. And it will remain exactly the same on 31st December 2025, right? You are not going to change it, right? But non-monetary item, you are going to keep as it is, right? And monetary item which you have, you will convert, right? So that's the logic of this chapter, right? I have an exercise which I can, numbers speak better than theory here, right? But I can show you little theory on monetary and non-monetary, right? So you can exactly know what I mean, right? So let me put it here. So see here, foreign exchange on monetary items. So foreign exchange gain on can arise only on monetary items, right? And C is written here. And let's go here. You can even look here also is also good, right? So IAS-21, what it says, that with exchange difference arising on settlement, IAS-21 require the exchange difference arising on restatement or retranslation must be recognized in the P&L account, right? So any difference we have on monetary item, we will be putting that to P&L account of the concerned year, right? And this is the difference. So if you look at this flow chart nicely presented here, right? So monetary items are unit of currency held, asset or liability to be received or paid, or you can use a single word settle, right? In future, in fixed amount, right? Like cash, receivable, payable, loans, right? If you take loan from a bank, you are going to repay it, right? So that one. And we are restating, look at the last flowchart part, restate or retranslate using the closing rate, right? Which is the balance sheet rate or the reporting date rate, right? And non-monetary item, we have other item in the statement of financial position, which are non-current asset. We have inventory, we have investment, we have fixed assets, right? Everything is there. We do not translate, right? And if an item is carried at fair value and revaluation will take its course as per the respective IFRS, right? So that's how foreign currency things works, right? I can take you to one example, right, which you can make little more sense on it, right? And this will be like, you can say, if you understand that example and if you're able to do that one, probably nothing better you can do, right? So let's look at this example here. And this cover a little part of revenue also, which is IFRS 15. Uh, Not very highly tested, but moderately tested, right? But it is the most important IFRS, which is IFRS 15. Revenue, right? When I work with companies, anytime when I'm auditing, I go to finance manager's cabin and I see what they're doing. All the time I see this IFRS is open. They're always on it, right? With the lengthy IFRS, right? And it has got importance from the logic mentioned inside, right? Because if your sales go wrong, if your revenue go wrong, then everything will go wrong. So we will have to concentrate on this IFRS, right? So here what we have, a company based in Mumbai and they have INR is their functional currency, right? So when your company is in India, your corporate office in India, you may have branches or other offices everywhere, right? We look at their corporate office on where your primary business is, right? Like say for Reliance, I'll say that for Reliance, the functional currency will be Indian rupees, right? And like say for Microsoft, the functional currency will be US dollar, right? So that's how we have. So a Mumbai-based company have INR as functional currency, and company has taken foreign transaction and passed the accounting entry as per IFRS 15 and IAS-21, right? So say on 21st of November, what you did, company signed a contract for selling the $12,000 worth of material to Sigma Limited, a London-based customer on a credit term of 60 days. That means customer will pay after 60 days. So a question to you, right? What you will do on this day? Probably nothing, right? You have not done any transaction on this day. It is just that you have signed a contract, right? Nothing is coming out to you, nothing is going from you. You have not sold material yet, you have not received any money yet, right? But still in exam, when we do marking for ACC exam, always write it, right? So right there on 21st November 2024, even if contract is signed with the customer with certain terms mentioned there, right? But still it's not an accounting transaction item and no accounting effect will take place. Write this, right? So examiner can give you 1 mark, right? If you do not mark, maybe you get nothing, right? Because you have not mentioned it, right? So right there on 21st November, you get nothing, right? No entry. Then on 3rd December, company bought furniture from a Georgian supplier for $50,000 on a credit of 30 days. That means Novartis is paid to Georgian supplier on 2nd of January. So see what happens here. You are buying furniture. So what should be your debit and credit? You will debit the furniture, right? Furniture is coming in and you will credit the Georgian supplier, right? Don't do a mistake of crediting accounts payable here, right? It's not accounts payable, right? You're not going to resell furniture. Furniture is your fixed asset, right? So say it as a supplier of furniture, right? Then on 8th December, Sigma or as a customer, they paid to you 3,000 towards purchase of a material, right? Now see if you have received some money from customer, right? Your sale hasn't complete yet, right? When IFRS say when sale should be recognized, when seller has fulfilled all the obligation, right? Shipment date is a very benchmark date there, right? So when you fulfill all the commitments, all the obligation, all the duties, nothing in your control now, then we can say the control of material shift from seller to buyer, right? So in this case, nothing to be done, right? But customer has paid money, so money is coming to your bank account. So I'll still debit the bank and I will credit advance received from account receivable, right? Customer has paid you 3,000 as advance receivable, right? Remember, no sales, right? Follow IFRS 11, 15, right? And so this is, how your questions are mix of 3, 4 IFRS, right? Especially if they are big questions, right? For higher marks. Now on 15 December, you ship the material worth 10,000 to customer via Mux Sea Line, and the ship will reach London port on 3rd January. So now see, on 15 December is your benchmark date or signature date when you should recognize sales because you have shipped the material. Now nothing is in the seller's control. Once ship starts selling, you cannot call ship back, right? Think logically, right? So this means this is the last thing you could have done and you've done it. So on 15 December, you will recognize a sales. And how much amount you will recognize? The initial contract was say for 12,000, customer paid 3,000, nothing matters to us, right? How much he shipped is only $10,000, right? So I'll say $10,000 account receivable, 2 cents. That should be my entry, right? And now what should be the amount? So amount will take transaction date. So 15th of December, whatever is my rate here, on 15 December, my rate is 83 INR, right? So $10,000 into 83, that should be my sales on this date, right? 15th of January, right? Now the ship will reach London port, you are assuming on 3rd January. What to do? Nothing we have to do, right? Nothing we have to care for. Once you ship the material, then you are out of the picture and control of material shift to the buyer, depending on your Incoterms and little technical things, right? Now, on 2nd January, you have paid to the Georgian supplier for furniture you bought, right? 50,000. So what you'll do, simply supply debit to bank, right? 50,000, and we will apply this rate. So on 2nd January, the rate is 78 INR, right? And when you bought the material, that was 3rd of December. On 3rd of December, the rate was 79. So that has gone down. Indian rupees have appreciated a little, right? And US dollar has gone down. So from 79 to 70 is simply, right? Earlier your amount was 79, you have to put at 78, right? But remember, there is a balance sheet date here, 31st December, right? So what you have to do, you have to do conversion 2 times, right? So first 50,000 you will show on the transaction date, which is 3rd December, which will be 79, right? Then you will come on the balance sheet date, the rate is 84. So put it at 84 on balance sheet, right, on 31st. And now on 2nd January, 78. So now the profit and loss will be counted from 78 and 84, right? And that's how you have to do, right? So you have to look questions very clearly, right? What question is saying. And always remember, for monetary item, we have to convert them on the balance sheet date, right? That's a compulsion. That's what IFRS says, right? So 3rd of December, when you buy furniture, you are transferring at the rate of transaction date. And on 31st December, you are accounting for a loss here, right? Whatever you get as a rate, right? Rate has increased, so you lose some money, right? And then when you pay, the difference will go to gain, right? So on same transaction, you can have in 2 days time, you will have one loss and one gain, right? That's how foreign exchange market, right? And it fluctuates every moment, right? We have four market basically, right? London, Tokyo, New York, and Sydney, right? And it works 24 hours round the clock, right? So when Sydney start first, then it goes to London, then it goes to New York, and then it come back to Tokyo, right? So this is a 24-hour market, and the size of this market is, if you add all the world's stock exchange, including Nasdaq and New York, Mumbai Stock Exchange, add all of them, multiply by 5 times, that itself is FX market, foreign exchange market. So remember that foreign exchange rate is never stable. If you look at any website now, whichever you're following for conversion, you will see it's changing very quickly, right? In 30 millisecond, it will change, right? So exchange rate never remains same. And you as a businessman, you have no control on it, right? So you have to simply address it, right? You have to adjust this risk. And there are many financial tools which we have, you must have seen in AFM, right? In financial management, we go to a bank and we deal with them to a advance forward contract, right? And fix the rate, right? So we can fix our rate also, right? But here we are looking at accounting majorly, right? So remember, on accounting, transfer it on balance sheet, right? Now your ship has reached London port on 5th of January. What you do? Nothing. But it's still mention again to get the track that one mark right there, that on 5th January the material has reached London and customer have collected the material from authorities on this day, but there is no accounting effect of it, right? And no accounting. Now on 11th January, the customer has paid you the balance amount and you allowed some discount, right? So you'll say cash on this amount, right? And you will apply this, that. And discount allowed and also debit is your expense. And you credit the account paper, right? Account receivable, right? So account receivable will be affected 3 times. When you sold, it is this date, which was 83. Then account receivable, you convert it to 84, right? And then again, when you're receiving is 87. So you have to pass entries 3 times, right? And that's how you have to do accounting, right? So it will be, I will say, a little uh, lengthy transaction, right? And that's how you have to do it, right? And now I can take you back to the chapter, right? And this is how, our chapters are. If you look at the list of chapters, right? These are all based on your earlier FR subject which you did, right? And there is nothing new here, right? All of them are here, right? So well done, guys. Today I'll probably see you in the next class, right? And we will jump into maybe some other IFRS, right? And then I'll open the floor for your questions. I always welcome your question, guys. More question you ask, remember, more question you ask, more you score in exams, right? If you don't ask questions, you'll score very less in exam, right? And that I can probably guarantee you with my experience, right? I remember my students who score ranks there, right? One of my students scored first All India rank recently, right? In July exam, right? So you see what they are doing. I always see them be interactive, right? They will talk to me, they will ask some question, right? And this is what explore, the unexplored part of your thinking, right? So this is a complete logical thing, logical subject. And even after passing your ACC, this is what you are going to do if you work in accounting, right? ACC work in every department, auditing, accounting, even internal auditing, right? But if you work in accounting or financial or revenue assurance, this is what you are going to do. Apply all the IFRS and make the financial statement, right? And if you're working in auditing, you are on other side, kind of, looking at the evaluation of them, right? And again, you are doing the same thing, right? So it's one of the most important and practical subject, and that's why it's a compulsory subject. So well done, guys. Today I will see you in the next class. I close this meeting now.